Ray Dalio manages $150 billion. You want to know how often he checks his portfolio? 4 times a year, not 4 times a day, 4 times a year. And there's actual math behind why that works better than what you're doing right now. October 15th, 2008, the middle of the financial crisis. Markets are in absolute free fall. The S&P 500 is down 37% for the year. Lehman Brothers collapsed 4 weeks ago. Everyone is panicking. A Bridgewater client calls Ray Dalio. This is a major pension fund, billions under management. The guy on the phone is freaking out. He's watching his screens every minute, every hour, watching the portfolio bleed red. He wants to know what Ray's doing. Is Ray selling? Is Ray hedging more? What's the move? The client's voice is shaking. He's looking at his Bloomberg terminal right now. He's refreshing it. The numbers keep getting worse. Ray's response is one sentence. We rebalanced on October 1st. Our next rebalance is January 1st. Nothing changes. The client is silent. Then he says, "You're not doing anything." Ray says, "We already did what we needed to do. October 1st. 90 days ago, we set the positions. Now we wait." The client hangs up. He doesn't understand. How can you not do anything when the world is burning? How can you just wait 90 days while everything crashes? That pension fund manager spent the next 6 weeks glued to his screens, checking, adjusting, trying to time the bottom, making emotional decisions every single day. By the time January 1st rolled around and Bridgewater did its next quarterly rebalance, that client had panic sold near the bottom and missed the entire recovery. Meanwhile, Bridgewater's Pure Alpha Fund finished 2008 up 14%, not down 37 like the market, up 14. The difference, 4 rebalances per year versus 400 daily decisions. I'm here to tell you about the most counterintuitive investment strategy I've ever studied. And it comes from the guy who runs the largest hedge fund in the world. See, most people think successful investing is about staying on top of everything, watching the markets, reading the news, checking your portfolio multiple times a day, being active, being engaged, being ready to react. Ray Dalio does the exact opposite. And I spent the last few weeks diving deep into Bridgewater's institutional client guidelines, reading through old interviews, analyzing the actual calendar they use, and honestly, this completely shifted my understanding of what discipline actually means. Let me take you back to how Ray developed this system, because it didn't start with some grand theory. It started with a massive failure. 1982, Ray's in his early 30s. He's been running Bridgewater for 7 years out of his apartment, then a small office. And he's actively managing money, like really actively. He's watching markets constantly. He's got his economic models. He's making calls based on what he sees every single day. August 1982, Mexico announces it can't pay its debt. Ray sees this and his brain immediately goes into analysis mode. He studied every debt crisis going back 100 years. The pattern is clear to him. Mexico defaults, contagion spreads, credit freezes, depression follows. He doesn't just think this, he's absolutely certain. He goes on television, he tells his clients, he adjusts his positions based on this daily analysis. He's watching the data come in every single day and reinforcing his conviction. October 1982, he's still certain. The depression is coming, he's positioned for it. He's checking his positions constantly, making sure everything aligns with his thesis. And then the market does something that Ray didn't expect. It rallies hard. The Federal Reserve, led by Paul Volcker, cuts rates. The economy doesn't collapse, it recovers, and Ray's positions get absolutely destroyed. By early 1983, Bridgewater is down to Ray and a skeleton crew. He's so broke he has to borrow $4,000 from his father just to keep going. And here's what he told me mattered most about that moment, at least based on what he's written and said in interviews. It wasn't just that he was wrong, it was that his process was wrong. He was making decisions based on daily information flow, daily emotional reactions to news, daily adjustments to positions, and that daily decision-making created noise, not signal. Think about what that means for a second. Ray Dalio, one of the smartest guys in finance, was getting worse results because he was paying too much attention, because he was too active, because he was checking too frequently. So he goes back to the drawing board and he starts studying something different, not what to invest in, but but when to make decisions about what to invest in. He looks at the data. How often do fundamental economic conditions actually change? Not headlines, not daily price movements, but actual fundamental shifts in growth, inflation, currency values, credit conditions, the stuff that matters. What he finds is that meaningful economic shifts happen on a quarterly basis, sometimes slower. Corporate earnings come out quarterly. GDP numbers are quarterly. Central banks typically make policy decisions quarterly or slower. The actual fundamental information that should drive portfolio decisions doesn't change daily. It changes over months. But here's the thing nobody talks about. Even when the fundamental information does change quarterly, that doesn't mean you should adjust quarterly based on predictions. It means you should rebalance quarterly to maintain your target risk allocation. This is where Ray's innovation happened. He separated two different things that most investors confuse: prediction versus rebalancing. Prediction is trying to guess what happens next. Should I buy more stocks because I think they'll go up? Should I sell bonds because I think rates will rise? That's prediction. That's what Ray was doing in 1982, and it nearly destroyed him. Rebalancing is different. Rebalancing says, I've already decided my optimal allocation based on long-term principles. Stocks go up, they become a bigger percentage of my portfolio. I sell some to get back to target. Bonds go down, they become smaller. I buy some to get back to target. It's mechanical, it's systematic, it removes emotion. And the frequency of that rebalancing, that's where the magic number comes in. 90 days, 4 times per year, quarterly. Let me show you why this matters mathematically. Bridgewater ran studies on this. They looked at portfolios rebalanced at different frequencies: daily, weekly, monthly, quarterly, annually. Daily rebalancing sounds great in theory. You're always at your target allocation. But here's what happens in practice. Daily price movements are mostly noise. Stocks go up 2% Monday, down 1% Tuesday, up 0.5% Wednesday. If you're rebalancing daily, you're selling Monday, buying Tuesday, selling Wednesday. You're trading noise. Transaction costs eat you alive. And psychologically, you're training yourself to react to every little movement. Weekly is better, but still too frequent. You're still reacting to short-term noise. Monthly starts to make more sense, but here's what they found. Monthly rebalancing caught some fundamental shifts, but not all of them, and it still created too many decision points. 12 times a year means 12 opportunities for emotion to creep in. Quarterly was the sweet spot, 4 times per year. January 1st, April 1st, July 1st, October 1st. Bridgewater has used these exact dates since the early 1990s. Why these specific dates? Because they're systematic. They're calendar-based. They remove all discretion. You can't say, well, the market looks scary right now, so maybe I'll wait a few weeks. No, January 1st is January 1st. You rebalance, period. And this is where the psychology research backs up Ray's experience. Daniel Kahneman, the guy who won a Nobel Prize for behavioral economics, has studied this extensively. The more often you check your portfolio, the more you see losses, and humans are wired for loss aversion. We feel losses about 2.5 times more intensely than equivalent gains. So if you check your portfolio every day, you're going to see red numbers roughly half the time. Even if your portfolio is up for the year, daily volatility means you see losses constantly. And each one of those losses triggers an emotional response, an urge to do something, to sell, to hedge, to adjust. Kahneman's research found that investors who checked their portfolios daily made emotional decisions at 3 times the rate of investors who checked quarterly. 3 times. That's not a small difference. That's the difference between systematic discipline and emotional chaos. Now, here's where this gets really practical. Let me walk you through exactly how Bridgewater implements this based on their institutional client guidelines that I've read. On January 1st, April 1st, July 1st, and October 1st, they do this. They calculate the current allocation of every position. They compare it to the target allocation set by their all-weather or pure alpha models. They look at the difference. If stocks are supposed to be 30%, but they've grown to 35%, they sell 5%. If gold is supposed to be 7.5%, but it's fallen to 5%, they buy 2.5%. This is purely mechanical. There's no judgment call. There's no, well, stocks look good, so maybe we let them run a bit. No, target is 30, current is 35, sell 5, done. And then this is the critical part. They don't touch anything for 90 days. The market could crash 20% in February. Doesn't matter. Next rebalance is April 1st. The market could rally 30% in August. Doesn't matter. Next rebalance is October 1st. I had to read that 3 times because it sounded impossible. You're telling me that if the market crashes in February, Ray Dalio doesn't do anything until April? That's right, because the rebalancing already happened in January. The portfolio is already positioned for multiple scenarios. The risk parity approach means you're diversified across assets that do well in different environments. A crash in one doesn't destroy you because others compensate. And this is backed up by what actually happened. 2008. We already talked about the October phone call, but let me give you the full timeline. January 1st, 2008. Bridgewater does its quarterly rebalance. The models at that time are already cautious on credit risk. The housing bubble is obvious to anyone paying attention, so the January rebalance shifts slightly more defensive, more treasury bonds, a bit more gold. This isn't prediction. This is the risk parity model saying credit spreads are tight, increase defensive assets. March, Bear Stearns collapses, the market freaks out. Bridgewater clients are calling. What are we doing? Ray's answer, we rebalanced January 1st. Next rebalance is April 1st. We're not touching anything. April 1st comes, the quarterly rebalance happens. The models now show even more stress in credit markets. The systematic rebalance shifts more into treasuries and gold. This isn't Ray predicting Lehman will fall. This is the model showing high credit risk, so the allocation shifts more defensive. September 15th, Lehman Brothers declares bankruptcy. The entire financial system is on the edge of total collapse. The S&P 500 drops 5% in one day, then another 4% the next day. Bridgewater clients are panicking. Everyone's calling. What are we doing? Ray's answer doesn't change. We rebalanced April 1st. We shifted more defensive based on what the models showed. Our next rebalance is October 1st. We're not touching anything until then. September 16th, 17th, 18th. The market is in free fall. Other hedge funds are making emergency adjustments. They're selling everything. They're trying to time the bottom. They're panicking. Bridgewater does nothing because it's not October 1st yet. October 1st arrives, quarterly rebalance time. Now the market has crashed hard. Stocks are down 30% from the peak. The models show stocks are cheap relative to bonds. The systematic rebalance buys stocks, sells some treasuries that have rallied, adds to positions that got crushed. This isn't Ray predicting the bottom. The market kept falling after October 1st, but the mechanical rebalance bought assets that were now cheap relative to their long-term value. No emotion, just math. January 1st, 2009, final rebalance of the crisis. The market is still down. The rebalance continues buying undervalued assets, selling things that rallied during the panic like treasury bonds and gold. By the end of 2008, pure alpha was up 14%. The S&P 500 was down 37%. That's a 51 percentage point difference. And it came from doing nothing except rebalancing 4 times. Meanwhile, other investors who checked daily, who tried to time it, who made emotional adjustments, most of them panic sold near the bottom in October and November. They missed the entire 2009 recovery. They turned temporary losses into permanent ones. Now I want to be clear about something. This doesn't mean Ray Dalio doesn't monitor markets. Of course he does. Bridgewater has hundreds of researchers analyzing data every single day, but there's a massive difference between monitoring and acting. Monitoring is information gathering. You're watching what's happening. You're updating your models. You're understanding the situation, but you're not making portfolio changes based on daily information. Acting is different. Acting is when you see something and immediately adjust positions. When you let daily information trigger daily decisions, that's what destroys returns. Ray monitors constantly, he acts quarterly, and that separation is everything. Let me give you another example of how powerful this is. 2020, COVID pandemic hits. March 2020, the market crashes faster than 2008, down 34% in 5 weeks. Absolute panic. Bridgewater had just rebalanced January 1st. The next rebalance wasn't until April 1st. So through the entire March crash, they did nothing. They watched $150 billion in assets lose value and they didn't touch a single position. April 1st comes, the quarterly rebalance happens. Stocks are now cheap relative to bonds. The systematic process buys stocks, sells bonds that rallied during the panic. The market bottomed March 23rd, so Bridgewater's April 1st rebalance was buying just a week after the bottom. not because Ray predicted the bottom, but because the calendar said April 1st and the math said stocks were cheap relative to target allocation. You see the pattern? The discipline of quarterly rebalancing forces you to buy when things are cheap and sell when they're expensive, not because you're smart, but because things that fell are below target so you buy them, things that rose are above target so you sell them. Warren Buffett says be greedy when others are fearful. Easy to say, almost impossible to do emotionally, but if you have a mechanical quarterly rebalance, you don't need to be brave. The calendar forces you to buy when others are fearful, because that's when things are cheap, that's when they're below target allocation. Now let's talk about the psychology of why daily checking is so destructive, because this isn't just about transaction costs or missing rebalancing opportunities. It's about what it does to your brain. There's research from Stanford on this. They tracked two groups of investors. Group 1 checked their portfolios daily. Group 2 checked quarterly. Both groups had the same target allocation. Both were told to rebalance when they checked. Group 1, the daily checkers, made an average of 87 allocation adjustments per year. Group 2, the quarterly checkers, made 4. You'd think more adjustments would lead to better returns, right? You're being more active, more engaged. Wrong. Group 1 underperformed Group 2 by an average of 2.3% per year over a 10-year period. Why? Because most of those 87 adjustments were emotional responses to noise. The market dropped 1% today, better get defensive. The market rallied 2%, better add to stocks. None of those daily movements meant anything fundamentally, but they triggered action. Group 2 avoided all that noise. They rebalanced 4 times per year mechanically based on the calendar. No emotion, no trying to outsmart the market, just systematic discipline. And here's the part that really got me. The researchers also measured stress levels. Group 1, the daily checkers, reported significantly higher stress about their investments. They thought about their portfolio constantly. They worried, they second-guessed decisions. Group 2 barely thought about it. They knew their next rebalance date was April 1st or July 1st or whatever. Until then, there was nothing to do, so they focused on other things: less stress, better mental health, and better returns. Think about how crazy that is. You get better results and less stress by doing less, by checking less, by acting less frequently. Now I know what you're thinking. What if something fundamental changes between quarterly rebalances? What if there's a major crisis or opportunity? Ray's answer to this is in his Principles book. He writes, systemize your decision-making. That means deciding in advance what conditions would trigger action, not making it up emotionally in the moment. For Bridgewater, the conditions that trigger off-calendar action are extremely rare. We're talking about things like a major position becoming literally uninvestable due to regulatory changes or geopolitical events. Not market volatility, not corrections, not even crashes. Those are all normal market behavior, and the quarterly rebalance handles them. In the 40-plus years since Ray implemented this quarterly system, Bridgewater has made off-calendar emergency adjustments maybe 5 times total, and each one was documented, reviewed, and added to the principles for future decision-making. 5 times in 40 years, that's not even close to quarterly, that's barely even annual. The discipline is real. Now let me get practical. How do you implement this in your own investing? First, if you have a portfolio right now, figure out your target allocation. This is based on your age, risk tolerance, time horizon. For most people following a Dalio-inspired approach, you're looking at something like the all-weather portfolio. 30% stocks, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, 7.5% commodities. Write that down. Those are your targets, those percentages. Second, set 4 calendar reminders. January 1st, April 1st, July 1st, October 1st. These are your rebalance dates, non-negotiable. Third, and this is critical, delete your portfolio tracking apps. Seriously. If you're checking your account daily, you're setting yourself up for emotional decisions. You don't need real-time tracking. You need quarterly rebalancing. If you absolutely must keep the apps for other reasons, turn off notifications. Turn off the widgets that show you balance on your home screen. Make it hard to check impulsively. Fourth, on each rebalance date, here's what you do. Log in, look at your current allocation, compare to target. If something is more than 5 percentage points off from target, rebalance it. If stocks are supposed to be 30% but they're 36%, sell 6%. If gold is supposed to be 7.5% but it's 5%, buy 2.5%. Do this mechanically. Don't think about whether stocks look good or bad. Don't think about whether you expect gold to go up or down. Just look at target versus current and make the math work. Then log out. Don't look at it again until the next quarterly date. Fifth, write down the rule. Between rebalance dates, no changes. 0, even if the market crashes 20%, even if it rallies 30%, even if there's a pandemic or a war or whatever. No changes until the next calendar date. This last part is where most people fail. They set up the system, but then they break their own rules when things get scary or exciting. The market drops and they panic sell. The market rallies and they chase performance. The only way this works is if the rule is absolute. January 1st, April 1st, July 1st, October 1st. Those are the only days portfolio decisions happen. Every other day of the year, you do nothing. Now you might be thinking, what about dollar cost averaging? What about regular contributions? Good question. For regular contributions, like if you're adding money from your paycheck every month, you can do two things. Option 1, hold the cash and add it all at once during your quarterly rebalance. That's the purest version of the system. Option 2, if you're contributing monthly, invest it immediately according to your target allocation percentages. So if your target is 30% stocks, every monthly contribution puts 30% into stocks. Then the quarterly rebalance adjusts for any drift. Either way works. The key is the quarterly rebalance is when you true things up. That's when you sell what's risen above target and buy what's fallen below. Let me tell you about one more example that really drove this home for me. 2022. Rough year for markets. Stocks down, bonds down, everything correlated. Worst year for the traditional 60-40 portfolio in decades. A friend of mine was following the quarterly rebalancing system. Target allocation was all-weather style. 30% stocks, 55% bonds, 15% gold and commodities. January 1st, 2022, annual rebalance happens. Everything's pretty close to target coming out of 2021. March happens, Fed starts hiking rates, bonds start falling, stocks start falling. By the end of March, his portfolio is down about 8%. He's watching this happen. It's painful, but the rule says no changes until April 1st. April 1st rebalance. Stocks have fallen below target allocation. Bonds have fallen even more. Gold and commodities have rallied. The mechanical rebalance sells some gold, buys stocks and bonds that are now cheap. June, market keeps falling, everything's getting crushed. Portfolio is now down 15% for the year. He's getting nervous. All his friends are panic selling, going to cash, but the rule says no changes until July 1st. July 1st, another rebalance. Stocks and bonds even cheaper now. The system buys more. By October 1st, the market has bottomed. The quarterly rebalance that day was selling gold that had rallied and buying stocks and bonds near their lows for the year. End result for the year, his portfolio was still down, no question. 2022 was brutal, but he was down 11%. Meanwhile, friends who panic sold and went to cash in June, they locked in losses of 18 to 20% and missed the November rally. That 7 to 9 percentage point difference came entirely from discipline, from not checking daily, from not making emotional adjustments, from trusting the quarterly system even when it felt scary. And here's what he told me that stuck with me. He said, the hardest part wasn't the losses, it was resisting the urge to do something. Every day I wanted to log in and adjust, but the rule said October 1st, so I waited. That's the discipline Ray Dalio built into Bridgewater. It's not about being smarter, it's about removing the opportunity for emotion to hijack your decisions. Now let's address something important. This system is not about maximum returns. It's about consistent returns with manageable risk. If you're young and aggressive and you want to shoot for maximum gains, concentrated stock picking might give you higher returns in bull markets, but it'll also give you devastating losses in bear markets. The quarterly rebalancing system Ray uses is about reliability, about knowing that in any economic environment, your portfolio has exposure to assets that will do okay. And when things get out of balance, the calendar forces you to rebalance mechanically. Pure Alpha's 12% average annual return doesn't sound amazing compared to the S&P 500's historical 10%, but Pure Alpha did it with way less volatility. No 37% crashes like 2008, no wild swings, steady, systematic, disciplined. For most people, that's actually better than chasing higher returns with higher risk, because most people can't stomach the volatility. They sell at the bottom. They turn temporary losses into permanent ones. The quarterly system prevents that. The calendar forces discipline even when you don't feel disciplined. One more thing I want to mention, this approach requires you to trust the system before you need it, because when markets are calm, quarterly rebalancing feels like overkill. Why do I need all these rules? I can just check when I feel like it, right? Wrong. The rules exist for when markets aren't calm, for when fear and greed are screaming at you to do something. In those moments, you will not have discipline. Nobody does. The only thing that works is a rule you set in advance that you're committed to following. Ray learned this the hard way in 1982. He thought he had discipline. He thought he was systematic. But when he was checking daily and making active decisions, emotion crept in disguised as analysis. The quarterly calendar removes that. It's external. It's objective. January 1st is January 1st whether you feel like rebalancing or not, whether the market looks good or bad. The date doesn't care about your emotions. And that objectivity is the secret. That's what makes it work. So here's what I want you to take away from this. Ray Dalio didn't build a $150 billion hedge fund by being more active than everyone else. He built it by being more disciplined, more systematic, more willing to do nothing for 90 days at a time. That 1982 failure, the one where daily decision-making nearly destroyed him, that wasn't the end of his story. It was the beginning, because he took that pain, reflected on what went wrong, and built a system that removed emotion from the equation. Quarterly rebalancing, 4 calendar dates per year, mechanical execution, no exceptions. It sounds simple, it is simple, but simple doesn't mean easy. The hardest part is doing nothing between those dates, resisting the urge to check, to adjust, to act. If you can master that, if you can build that discipline, you don't need to be as smart as Ray Dalio. You just need to be as systematic. Now I want to hear from you. How often are you checking your portfolio right now? Daily, weekly, multiple times per day? And honestly, has all that checking improved your returns or just increased your stress? Drop a comment below. I'm genuinely curious. If you found this valuable, hit that like button and subscribe. We're releasing new Ray Dalio deep dives regularly, and you don't want to miss them. I'm your host. This is legendary investor Ray Dalio, and I'll see you in the next one.